Guys, what's going on? You know why I always do this right before a video starts? It's because that you guys are gonna use your big old brains for this video. Why does 10K per share just feel like a stop along the way? Now, first of all, big grain of salt, big bucket of salt for this DD, as you guys understand that this is just currently a theory, a GameStop theory. The reason why you have to be able to focus up on these numbers and the Elliott wave theory, which is something that we're going to cover in extensive detail, is because one of the most important parts of the perception of this story is how do people feel about it, right? The narrative. And if you guys cannot shoot for the moon and aim to fall among the stars, at the end of the day, it becomes much more difficult to anchor yourself to a realistic price, especially since the short squeeze, as we've mentioned earlier and continue to mention, is difficult to pinpoint whether or not it is finite or something that is slightly greater than finite, because at the end of the day, right now, we're looking at a once-in-a-lifetime GME squeeze opportunity. So let us look at why 10K per share is just a stop along the way. Let me show you a little photo of the Elliott wave theory. So I know most of you likely have never heard of Ralph Nelson Elliott and his surprisingly called Elliott wave theory, but if you want to change that, I recommend that you read the free book here. I'm going to put that description link down below. Okay, let's summarize it real briefly. As you can see, our friend Ralph, let's call him, has a real hunger for tendies as a little kid. That hunger drove him to use his crayons on charts until he discovered that in the 1930s that the stock market always moves in recognizable pattern back, so-called waves, you know, like undulating, oscillating little waves. Simplified, there are only two kinds of waves. One, impulse, and two, corrective. So these impulsive waves, let's go and scroll down real quick and look at them. These impulsive waves are those that move the market and consist of 5 subwaves, because 5 is the smallest number of waves that can accomplish an overall movement, right? This is just part of his theory. Meanwhile, corrective waves, well, these are few, although there are just a few different corrective patterns, we can say in general that they consist of 3 waves, because that's the smallest number needed to achieve a retracement. So we have corrective waves that accomplish retracements where the stock goes up and then falls below, gets rejected, or starts to have a pullback. And there are these impulse waves that can consist of 5 subwaves. Right here is the motion of the ocean right there, and that is the smallest number of waves that can accomplish overall movement. You probably have seen this in GME and AMC recently. I'm going to keep this one up because this is the 10D making one that we like. So before we take our colored crayons and apply this mind-blowing knowledge on GME, there's also a few things you should understand. Each wave can and should contain waves in itself, like a waveception. So it sounds complicated, but you should understand that, you know, the 1, 2, 3, 4, 5 impulse wave alone, you should be able to not only see that on the monthly chart, but you can also see that in the daily chart, the minute chart, and on and on. You should be able to fit another 1, 2, 3, 4, 5 within these other 1, 2, 3, 4, 5s. And that's number 1. Number 2, each of these impulse waves is followed by a corrective wave. So after 1, 2, 3, 4, 5, we're going to see a corrective pattern like this in A, B, C. So that is the current pattern of Mr. Ralph here. You're saying that Ralph knew how to predict the market 100 years ago? Hey, the p-value was invented. The p-value that we are most likely to reject the null hypothesis nowadays is, like you guys probably remember from stats class, 0.05. So this is also something that was created 100 years ago. So why is this any different? So Elliott waves are, you know, in this DD, highly accurate in their opinion to predict what a market or a specific stock is going to do. Unlike most indicators, it doesn't lag behind. However, there are still cases where multiple patterns could be applied, and only a few more candles on the chart will be clear which of them are actually correct. So let's give a look at our very first launch in January. So this is what the January Gamma Squeeze looks like. During our first rocket launch that got canceled by Robinhood, they used Elliott waves to estimate how far that rocket might go. So they shared a screenshot initially here, and they mentioned in a further reply that they reached that range, that a drop of the range of 137 to 207 will likely follow before our rocket finally launches to more than $4,000 a share. So let's look at this photo here. As you can see, both statements were highly accurate in their opinion, only because buying restrictions did the drop go further than it should have, and had that rocket takeoff was canceled. So if you follow great. If not, then let us remind you that that book is in the description below if you want to read up a little bit more about Elliott waves. Honestly, Investopedia could get you there as well. So go ahead and check it out. We have only 3 minutes until the market opens. So $10,000 per share is now just a stop along the way, while preventing the launch back in the hedge funds sucked up. There are now more people buying tickets for their trip up to space, especially including the stimulus checks here. So Elliott waves are, in simple terms, nothing else but a manifestation of human behavior on the market. However, and beyond average manipulation, all the crazy tools and tricks that the hedge funds have pulled out makes it harder to say with absolute certainty that the following pattern is accurate. So let us, but since they're going to reflect their opinion, let's share them anyway. Focus on this chart right here. This way, the way that it currently looks right now is that we're currently in a corrective wave 2. Remember, the corrective waves and impulse waves. And it's developing as an ABC pattern. Both of these aspects show a corrective into the current range, although we haven't reached the predicted range for C in the ABC pattern. Maybe we won't, but we probably won't be surprised if the price falls in the range of 131 to 161 to confirm both predictions and possibly also close the gap that's still open from the 5th to the 8th of March at $140. Okay, that would mean that we are likely at the end of the wave number 2 within a 1, 2, 3, 4, 5 impulse. So you see that what he drew here, we have the ABC, but if we take and extrapolate that information, right, all of this is the same chart, except that this is what the 1, 2, 3, 4, 5 impulse would look like. Now the projection for the following wave 3, 4, 5 looks like this and already gets us into a range $10,000 to $13,000. Okay, so we have taken some crayons, put them on the chart and said, look, this looks like they're 10,000 to me, at which point we see a corrective pattern ABC. In their opinion, it's going to be a few paper hands, scissors in the chat for those paper hands, that sell at that price. A lot of mental barriers that are going to come between us and 10 grand. So as mentioned earlier, each wave consists of smaller waves. So the 1, 2, 3, 4, 5 impulse you can see in the image above is actually just wave number 3 in the bigger 1, 2, 3, 4, 5 impulse. So that's why we're looking at this one. Over here, currently a market correction as GameStop plummets these past few days from a new record-breaking high for this version of the squeeze, and now this is the extrapolation. Too long, didn't read. In their opinion, GME will short-term go around 2,000, at which point they'll see a small retracement, and then we'll have to move to our pre-launch stage at 10 grand a share, followed by a drop to as little as 7 grand a share, followed by the rocket ship takeoff to 100K or more. They learned all of this from a very old ape called Ralph Nelson Elliott that used his crayons in very interesting ways. So what do you guys think? We have basically 60 seconds before the market opens, maybe even less. But before that happens, before all of these crazy shenanigans, before perhaps the catalyst for the many catalysts that are going to start the GameStop theory, does this 100-year-old theory from a man named Ralph feel right? And as markets open, I will see you in the next one. Peace.